Hello, and welcome to Sense and Sensibility, the Inflation Guy podcast. I am Michael Ashton. I am the Inflation Guy, and I am your host. And today on the podcast, we're going to talk about policy volatility. I'm sure we're going to be returning to uncertainty and policy volatility for some time. We're going to talk today about systemic adaptability and how that how the system responds to that uncertainty and what the consequences are if it does or does not. But before we do that, I want to first thank our sponsors. This episode of Sense and Sensibility is sponsored by Simplify ETFs, a fast-growing manager of liquid alternative ETFs. Simplify is bringing Wall Street to Main Street by providing access to institutional strategies perfect for diversifying your equity and bond portfolios, previously only available to big institutions and the ultra-rich. Check out their website at simplify.us. That's simplify.us. And you can find their entire lineup of ETFs at simplify.us/ETFs. Now, as I said, clearly, and it's clear to all you, I don't even need to say this, uncertainty and volatility is a theme that we're going to be returning to time and time again for some time. It was not that long ago, episode 132, when the title of that episode was "Crazy is Anti-Inflationary," and so literally we're going to be talking about this, every couple of months, I think. Let's first remember why it is that policy uncertainty, what I called crazy, what a lot of people are calling crazy. Tariffs going up, tariffs going down, administration policies that kind of wax and wane day to day or week to week. Why is that anti-inflationary? And the quick reason is that when things are uncertain, consumers tend to hold more cash. Right. So cash is, among other things, there's a precautionary demand for cash balances. And when that precautionary demand increases, and there's a tendency then to hold larger cash balances on average, and that has a tendency to lower velocity, because velocity is the inverse of the demand for real cash balances. And in fact, the first quarter velocity in the U.S. fell slightly. It fell a little bit in the fourth quarter, although I think that might have been revised away. But and then in the first quarter, and that's exactly what you would expect to see. And again, I talked about this in episode 132. There is the big effect on velocity is interest rates, which cause you to want to hold more or less cash balances, depending on what your other opportunities are out there for that cash to earn an actual yield. One of the other big impacts is uncertainty, and we saw this. We saw this during COVID, and of course, the other thing which happened in COVID was there was a massive money drop that artificially increased cash balances quite a bit, but the reason people held on to those cash balances was partly because of the great uncertainty around COVID. So we saw this plunge in money velocity mechanically, and then we spent the last several years having the truck catch up to the car, right? So I explained it as the car accelerating away, and velocity being sort of the spring that sort of was keeping. If the car speeding away is money, and the economy is the trailer, it's connected. Those two things are connected by a spring, and so as the money supply sped away, but the economy takes a little while to come along, that spring stretches, and you knew that eventually, when the economy came along, that spring would contract, and so that's what kind of happened. We had this plunge in velocity, and gradually that kind of got erased almost entirely. And now you're starting to see velocity occasionally goes the other way. And right now it is going down very, very slightly, because of uncertainty. Anyway, that was a longer digression than I necessarily needed, but that I love that analogy about the car. And so I do have to, when we're talking about money velocity, when we're talking about money supply growth, for a long time now, we're going to have to always kind of go back and say, okay, during COVID, it worked a little bit differently. That was a very weird thing that happened. But right now, we're kind of back into a normal monetary policy environment. Money growth is back to kind of a normalish sort of level. It's still too fast for 2% inflation in this kind of environment, but it's in the 4 or 5% range. And we have money velocity that's stable. Right now, as I said, it has decreased recently because of uncertainty. Anyway, so uncertainty helps, in quotes, helps inflation stay down a little bit. Because of that uncertainty, tariffs obviously go the other way and swamp that effect in the markets where, in those product markets that are being tariffed, right? So on those goods that are directly affected by tariffs, you could ignore the whole uncertainty, tending to lower velocity issue. But that uncertainty dampening inflation operates on the whole economy because it operates through the monetary system. And that means that it tends to depress, say, service prices, which don't really have a lot to do with tariffs, right? So I think what we're going to see over the next several months anyway, is that we're going to see goods inflation continue to accelerate because of tariffs, while services inflation continues to decelerate. We're still going to end up in the high 3s, low 4s, but we're sort of changing sort of the leadership over the next few months, and it's because of the tariffs and because of the uncertainty around the tariffs. I don't think, though, that uncertainty, although we're going to be talking about it for a while, it's not going to be something that we're going to be talking about in October. It's dramatic right now. This uncertainty seems dramatic because it follows a period. All these policy changes, these sudden policy changes, follow a period of extreme neglect of policy when not much happened for the last 4 years. Not much happened very quickly because the people at the top were pretty happy with the way things were. So not much changed. There was uncertainty around COVID and COVID response, but there weren't a lot of policy changes. Of course, it's also objectively dramatic what the Trump administration is doing, and I don't want to sell that. We don't want to sell that short. But one of the reasons that right now it's such a big deal is that it's being directly compared to the end of the Biden administration. But the Trump administration seems to be starting with the really big changes and then working their way down to smaller changes. We saw, on when tariffs first went into effect, we saw 50, 100%, 150%, with Trump kind of upping the ante every day or every week. And we haven't heard a lot about that over the last couple of weeks. And so that's going to be the general trend, is that, yes, there's going to be further volatility, further economic policy uncertainty, especially when we get to the budget and taxes part of things. And on tariffs, as we come up with deals that fall apart and all that stuff, there's going to be some volatility around that, but it's going to be less volatility than the initial discontinuity was. And so that you're going to get this sort of second derivative effect where the overall policy uncertainty is quite high still relative to the prior regime, but relative to what it was 2 months ago, it's going to seem like less. And markets sometimes react more to the second derivative. Now, I'm going to talk about markets in just a second, but I do want to say, okay, yes, I've been talking about this uncertainty and the effect it has on money velocity and stuff like that for a while, but I am reconsidering something in terms of the effect on the growth part, on the economy itself. something that I said just a couple of episodes ago. In episode 138, I talked about the adaptability of manufacturing and how every manufacturer of any reasonable size that has backup qualified suppliers. If you need intermediate goods from somewhere, you've got a supplier, and that supplier is in India, and one of the things you learned out of COVID, if you hadn't learned it before, is you better have some backup supplier that's located more close, more nearby, whether it's a domestic U.S. manufacturer, or it's Mexico or Canada, whatever, it's something nearby. And every manufacturer has those backup suppliers. Now, if you're an auto manufacturer and you got all your parts from Canada, your backup supplier, it can probably not overnight supply all of the imports that you're going to lose from Canada, or that are suddenly much more expensive from Canada, but you do have a backup supplier. Okay. So this is what, I talked about that in episode 138 and talked about how manufacturers are supposed to adapt to things like tariffs, embargoes, COVID, various other problems. That just happens. The economy is not always, steady and predictable. And in your job, if you're in the corner suite, is to not let those upsets destroy your business. That's literally what all you're supposed to be thinking about all the time, is what's the worst that can happen, and how can I make sure that sort of thing doesn't end up happening. And so I wasn't terribly worried about the manufacturing, the overall manufacturing economy of the United States, especially when tariffs ought to make it better, ought to push more demand domestically. I wasn't super worried about the domestic economy. But I'm reading about how Apollo Global Management is forecasting a massive wave of layoffs and bankruptcies in the trucking sector as a result of recent tariffs, and they're forecasting a severe recession. And neither of those things make much sense to me if I'm right about companies being adaptable. If trucks aren't picking up imports, from ports, right? And we know that shipping imports into, in particular, the West Coast, the port of Long Beach, where a lot of Chinese imports come in, port landings are down hugely, 30 or 40% or something like that in container traffic, and which means fewer trucks. And so Apollo says, well, if you're going to drop the number of containers 30 or 40%, then everyone's going to go out of business. Okay, well, but if trucks aren't picking up those imports, then they're going to have to pick up goods from manufacturers domestically, right? So whether they're finished goods, so if we're not importing the stuff from China, then either the manufacturers here are producing finished goods that are replacing the finished goods they would have otherwise imported from China, right? So we can't buy toys from China, so we make toys here. And the trucks will need to pick up the fact, we're now making more toys, they'll have to pick up those toys, right? Or if you're an intermediate goods manufacturer that is now, you're an auto parts manufacturer, this doesn't really help. This doesn't make as much sense because it's Canada, but where we get most of our auto parts. But if you're, say, an auto parts manufacturer and all of a sudden now you're not getting those imports, well, suddenly your business is going to go up hugely, and you're going to need those trucks to take those intermediate goods to the end manufacturer for final assembly. So either way, that means that there's a need for those trucks. The only way you should get massive layoffs in overland shipping is if indeed there's a massive recession and demand dries up. So there's just nothing to ship. But the whole discussion, and I don't mean to pee on Apollo. I mean, there are other folks saying the same thing. It reminds me a little bit of when people thought that China not buying our farm produce anymore was going to lead to a massive collapse in farming, right? They're not buying soybeans. The current circumstance is a little bit different in that soybeans are commodities. So if China isn't buying them from us, then they're buying them from some other country. And if that other country doesn't have them to sell because they're selling them all to China, then that other country's customers will have to buy them from us. And so it's just rearranging trade in commodities. Unless the total demand for soybeans globally goes down, and the same thing with oil, right? So unless the total demand for oil or soybeans goes down, the fact that, one buyer isn't buying them from another country, but has chosen a different supplier of liquefied natural gas or crude or soybeans or wheat or whatever, just means that the shipping, the various counterparties have to sort of rearrange, but the overall system still works. You still are producing the same amount of commodities, and people are still buying the same amount of soybeans. They're just coming from a different place. So this is not, we're not talking about soybeans here. We're talking about intermediate goods and things like that. So it'll take longer to adapt, but it's the same basic idea. And it also reminds me of, during COVID, when people thought that COVID would drive all the restaurants out of business. And so we wouldn't have, all the restaurateurs would go to business. We were not going to have any restaurants when COVID was over. Well, some restaurants went out of business, but when people decided to eat out at restaurants again, guess what? There were restaurants that reopened. And so the total amount of restaurants turns out to be very closely related to the demand for eating out. And so if the demand for eating out doesn't go away, there will be plenty of restaurants. Might not be the same restaurants, but they'll be the same restaurants. In the same way, I have trouble seeing trucking going away. Typically in trucking, when you have recessions, it's because the trucking got overbuilt, right? And it's a very fractured industry. And so sometimes when we have boom times, trucking overbuilt, and then when you have a recession, a bunch of them go out of business. Okay, I can, if you believe there's a recession coming, I can see that. But if you think that we're going to lose a lot of trucking companies because there's nothing to ship from the Port of Long Beach, I don't see that absent a very large recession. So anyway, all of this is systemic adaptability, right? So supply chains, who's providing from where, how does it get from point A to point B, which countries are we buying from? All that is systemic adaptability. The system is supposed to be able to handle those things. If you're focused on static economics, right, you're going to miss that. You're going to say, well, I know that 30% fewer containers are coming into the Port of Long Beach, and I know that trucks pick up containers from the Port of Long Beach. Therefore, demand for trucks is going to go down 30%, and all these guys are going to go out of business. Well, that's only true if you kind of neglect the bigger dynamic part of the problem, which is that if we're not shipping stuff in from China, we've got to be making it or buying it from other places. And so, again, absent a massive fall in demand, those trucks are going to be needed to go pick up stuff from other places, unless it's all done by rail or air, but you get my point. All that being said, I do worry that our system overall has become less adaptable than it used to be. And I wonder if I'm not giving manufacturers a little bit too much credit. The Dallas Fed earlier this week released the monthly Texas Manufacturing Outlook Survey for April. The fun part of this report is always the comments and anecdotes, and there are other regional surveys, but this one seems to be, it comes out monthly, and it's always worth a read. Now, the comments and anecdotes are anecdotes, and so you don't want to rely too much on them, but they can tell you if you notice some commonality, they can tell you something about what's going on and how manufacturers in particular are thinking. And right now it's kind of alarming. I'll read you a couple of quotes. One anonymous, these are all anonymous comments. The report tells you what sector the company that is giving you the comment, what sector they're in. And if you knew the manufacturing economy really well, you could probably guess at some of these, but they're otherwise anonymous. So the first one here is from the computer and electronic product manufacturing industry. There is really no way to predict anything accurately 6 months or even 6 weeks out now for our industry due to the tariff and trade uncertainty. Carve-outs for large electronics businesses, cell phones and laptops, leave small business burdened to deal with tariffs on our own, which are likely to cause delays, cancellations, and early product obsolescence on existing products and orders. We have already had to turn around and refuse shipments because customers cannot afford the tariffs, delaying our ability to build, which will eventually lead to job losses. If this continues for any length of time, many small companies are likely to be significantly hurt or even gone. If we want to bring manufacturing back to the U.S., can we try not to kill the companies that can actually help do that before we get the chance? Maybe we can think about using a scalpel rather than a sledgehammer. The risk we face now is far greater and less understood than what we saw during the COVID shutdown. Really? This uncertainty is greater than the uncertainty around COVID? That seems like an insane comment. Okay, this next one is much shorter, from the non-metallic mineral product manufacturing. Okay, so non-metallic mineral product manufacturing. Okay, so non-metallic minerals. So I guess that's like, what's a non-metallic? Like quartz, something like that, right? Okay, here's the comment. Tariffs, tariffs, tariffs. There was a better way to do this. Okay, that doesn't tell me a lot about the business. It seems like a little bit of a whinge. From printing and related support activities, and this will be the last one, the administration's tariff policy is insanity. It is creating havoc in the manufacturing business. Okay, these are the most dramatic quotes from this report, but in general, many of the comments read as if business owners think that a placid economic environment is a God-given right. It isn't, right? I mean, we know that. I mean, if you study business at all, they don't start by saying, okay, so you start the business, you make a lot of money. I mean, it's hard. It's hard to start a business. There's a lot of uncertainty, right? If you require perfect foresight about conditions for the next year in order to be profitable, then you're not going to get it. And you're not going to be profitable. And you shouldn't get it. And planning as if you were absolutely going to get such foresight is going to cause big problems when we do get a change in administration or a war anywhere in the world or COVID. You better have a plan. That plan better be adaptable. What's it they say? A plan never survives first contact with the enemy. That's what manufacturing is. That's what running a business is, right? If you can't adapt, then the business should die. And part of the problem here is that for the last few decades, it's been difficult for larger businesses anyway to die. There's two ways to protect against volatility. And this is true on the business side. It's true on the market side. You can hedge against certain things, or you can hold capital. All right. So hedging includes things like insurance, options, futures. Like, if you're obviously if you're a refinery and you require a certain crack spread in order to be able to operate profitably, then there's a way to hedge that, right? There's a way to establish the crack spread. If you're a farmer and you require a certain level of, you've bought your stuff, your seed, you're putting it in the ground, and you'll lose money if corn prices fall. Well, you can hedge corn prices, right? So there's that. There's a way to hedge against, hurricanes. You can buy hurricane insurance, right? There's no good way to do that sort of in markets, but there are ways to hedge that. And if there's no good way to hedge, to buy a hedge, then you hold more capital. You just simply have to, have more, hold more money against a rainy day. Reducing leverage is capital, is holding more capital, and it's a good thing. The reason we've had such terrible recessions since the late 1990s is because business owners have held less and less dry powder, and they've levered up operationally and financially. In case financially, obvious what I mean by financial leverage. And operational leverage just means you get more and more fixed costs and fewer variable costs, right? So if you have very low fixed costs, very high variable costs, then you have a lot. You don't have much leverage. You're very, very adaptable. If you have really high fixed costs because you're trying to lower your overall cost structure, so you've got a bunch of robots and stuff, to lower your costs, and you don't have much variable costs, then you're not very adaptable. So that's That's operational leverage. And one of the reasons that business owners have done that over the last couple of decades is that we've had negative real rates in an artificially managed economy for a long time. That works. Having cheap money and carefully managing to avoid recessions, it works until it doesn't. And if when the music stops, you're not holding enough capital. The saying is that it's when the tide goes out that you learn who's been swimming naked. If you weren't holding enough hedges or capital to handle an adjustment period when one of these things goes bad, then you're the naked one. And it's also true, by the way, this is also true in the financial markets themselves, although here the incentives are even more perverse, less damaging to the entire system, I guess, than the manufacturing economy being fragile. But again, investors have held less and less dry powder and levered and risked up more and more, really since the 90s, the early 90s, when Greenspan started telling everybody exactly what they were doing with monetary policy and how they were going to address recessions and how they were going to fight against recessions and so on. Any change in the environment that the Fed did not immediately address was really damaging and caused selling because people didn't have any dry powder. Okay, if you personally, listener, not saying you're part of the problem, but if you have been concerned about the stock market since February, okay, when stocks fell, I don't know, 30%, I don't know, 20, they fell a lot. Okay, and if you've been really concerned about that, then you're too long. You're not holding enough capital. You're supposed to be able to ride those things out. Over the last 30 years, the Fed has encouraged you in that way by always standing by to catch things. They haven't always been successful because sometimes the flow is too big and the Fed can't catch it. But the reason those have been so dramatic is that the only time we see them is when it's something that's too big to manage. And one of the reasons they get big is that it's the leverage. It's the leverage, stupid. So the Fed thought about departing from that approach during the global financial crisis, when they let Bear Stearns fail and then they let Lehman fail. And then they didn't really like the reaction when Lehman failed. And so they kind of reined that back in. And they didn't let anyone else fail after that. The point is that volatility and letting the market do what the market does without trying to overmanage it is a good thing for the market, and it's a good thing for investors in the long run. If you have to dig your own foxhole, I wrote this actually in my first book, which wasn't a great book, but this was a good line. If people have to dig their own foxholes, there's someone shooting at them, and they have to dig their own foxholes, you can trust that they will dig them deep enough, right? And if you let people and you tell people you're on your own, okay, you're going to have to make sure that you have enough saved. You're going to have to protect against market sell-offs. We're not here. We're not going to be saving the market. We're not going to be saving the economy. Then people will save more. They'll hold more cash. They'll have more, lower risk investments and things like that. Of course, actually nowadays I'm actually more concerned about how many poorly managed businesses there are out there who will spend more time whining than adapting than I am worried about the market. The hard numbers in the economy aren't very bad yet, but the whining is showing up in the surveys, the fear from business owners. So that's why I'm worried about manufacturers. Now, the uncertainty itself ought to be a negative for financial markets, quite apart from businesses where you just have to do, uncertainty means that the equilibrium level of prices for a given level of economic activity, for a given level of profitability, the equilibrium level of market prices ought to be lower, simply, again, because if you're less levered, you're holding more capital, safer investments, then that means you're owning fewer equities. There's less investment in equities generally, which means lower price of the existing equities that are out there, and that's entirely rational. Now, having said that, it doesn't necessarily feel that way after the 20% rally in 3 weeks in the market. As I said earlier, it's kind of a second derivative thing right now. And this should give you some optimism about how the overall economy will respond going forward. Maybe the second quarter isn't so great, but going forward, as the uncertainty is still high, but it comes down from a very high level, just like the market has recovered, I do think that there's probably more downside to the stock market before we get upside. In the same way, I think there's more downside to the economy before we get the upside. But as that uncertainty eventually recedes, then then at that point, then you would expect the market to go back up. But clearly, the fear of missing the next big move higher hasn't yet been crushed, and until it is, it's hard to imagine that we really are going to have a healthy stock market, but rather, ones that are going to be subject to sudden gaps and setbacks. So I do wonder, clearly the Fed's multiple decade policy of having very negative short-term real yields and stepping in to try and avert every minor recession has caused the fragility in capital markets. But I hadn't worried about the actual business side of things and how monetary policy and to a lesser extent, I guess, administrative industrial policy had affected the actual business side of things, actual business of doing business. If long-term damage has been done structurally to make the system itself less adaptable as a result of the coddling of the Fed for the last 35 years, then less adaptability and more fragility also increases the equilibrium inflation level going forward. And that's what I'm concerned about today. And that's all for today, because this is already too long of a podcast. Do go back and please re-listen or listen if you haven't listened to it yet to episode 140, the White Whale podcast about the USDI coin. I think it's a really important podcast and very different from some of the other things that I've done. But that's all for today's podcast. And if you would, please like it. Please subscribe to it. Please refer other people. You can contact me at inflationguy@enduringinvestments.com. You can subscribe for free to the blog at inflationguy.blog. There's a lot of content there. Follow me on X at inflation_guy. Visit Enduring Investments if you need help with diagnosing and treating an inflation problem. And most importantly, defend your money. And if inflation is coming for you, remember, you know a guy.